Hello everyone, this is Ryan Mallory for SharePlanner.com. Today is January 30th, 2013, doing another session of LiveCharts. I'm going to be going over the general market direction. We're going to go over the stocks that we currently have in the portfolio, as well as the stocks that you have requested me to go over. So I try to keep these under 15 minutes for the sake of not consuming your whole afternoon doing one of these, and that's the plan. Let's go ahead and look at the S&P right off the bat. We're trying to make it 10 out of the last 11 days where we've traded higher. Quite a streak. There's a huge support level here with this 10-day moving average where the price just is moving basically like perpendicular with that moving average there. I'd say if it gets below 1490 or hits 1494 today, that would be quite a sell-off considering what we've seen so far this year. That 13-point sell-off would put us right at that 10-day moving average and probably would result in a bounce of some sorts. But I don't hold much optimism after the fact that we had a GDP report today that came in at negative 0.1%, and the consensus was 1.1% in the positive. So honestly, when I saw that report out, I looked at the futures expecting us to be just crashing 20-30 points lower. To say the least, we were about negative 2 points down. The market really could care less about that GDP report. So we also have the FOMC statement today. The Fed has been hinting lately in some of its speeches that different governors have been giving, particularly Ben Bernanke, is that it's running out of bullets. It'll be interesting to see if we see some of that same kind of language in today's statement. We'll have it posted on SharePlanner. But I'm definitely interested in seeing the kind of language that he puts in there this time, because they are running out of bullets. You just can't get doing QE after QE after QE after QE, and it sure does seem like that at some point. The roosters are going to come home to the chickens, as the chickens will come home to roost. And I think we're getting to that point where this market, yes, it's going up and up and up, but that's because the Fed keeps pushing people out of bonds and putting them into stocks, making it to where there's no money to be made in bonds. So everybody, including your grandmas and grandpas who should not be in the stock market, are getting into the stock market because they need some kind of return to live off of. And so that's fueling your market primarily. And then you got the chasers who are going after the January results, who are afraid they're going to get behind on this market this year early on and never recover. So they're pushing the market up by chasing the market. So when the FOMC statement comes out in about at 2:15, sometimes they're late on it, but don't pay much attention to that first reaction. Just note it. There's a second reaction that often comes in a reversal type form. That's because there's a lot of players that are out there trading options off of it, straddling the FOMC statement. So they're trying to close out both ends of their trade. So that's what causes that large spike in one direction and then the reversal in the other direction. Now the third move is going to either be a continuation of the second move after maybe some consolidation, or it's going to be a sharp spike back up in the opposite direction, confirming the first move. So it's that third move that you want to watch, because that's going to tell you usually the direction that this market's going to go, and usually it goes hard in that direction. So be cognizant of that. The FOMC statement will increase the volatility as it comes about. I will say this though, FOMC statements in the past year have not been as highly volatile as it had been in recent years. So it's the significance of it. I think people have found the Fed to become rather predictable. It's to keep pushing this market up at all costs. So that's probably priced into the market. Thus the reason why we're trading at plus 1,500 on the S&P right now. All right, enough about the S&P, enough about general economic conditions out there, and let's look at some of our current holdings. HDB, we got in this a few days ago, and I still like this chart a lot. You have this heavy area of resistance that this stock has popped up into, and it's still trying to do that. We have a stop loss at up in the 42s, so we're not in danger of hitting that yet, and that's a good thing at this point. We're not close to getting stopped out, but I am getting a little bit concerned that if we close above this I don't know, 40.86 level, that it could become suddenly bullish again based on the price action that we've seen in the last few days, because you have this morning star pattern. Let's just go ahead and get rid of this box here. You have a morning star pattern that could be forming today, which if it confirms anywhere near that 40.85, I may go ahead and close this position out, just because I don't tend to like trading against morning star patterns that are often bullish at times. They're marked by a sharp push down followed by a doji that gapped down the following day, and then the next day after that you have a gap higher and a strong candle as well. So if that's what we are seeing at the close, there's a good chance HDB will be cut, and that would probably only result in about a, I don't know, half percent loss or so, which isn't bad for a short or any trade for that matter to take a loss on. TGT, we've been holding this one for a while, for better part of a week now, and the chart still looks pretty good. It's bearish today when the market's trading flat. What I really want to see in this stock is for it just to push through that 60.75 level. That's not that far away. You're talking about a 0.5% of a move. I think at that point you're going to see a move down into the 59s. And if we can get through 59, then perhaps move down to 58 and maybe, you know, complete about a 5%, nail a 5% profit on this trade. GM, this is a new short from yesterday. So far so good. Working out perfectly as I had hoped it would. We got through 28.25, which I thought was a significant resistance level on the 5-minute chart. We're trading at 28.18, so now the next level that I want to see us break is this 28.11. So if we can get and close at 28.10 or less, I think we're set up pretty nice for a sub 28 move, maybe down to $27 perhaps. In which case I'd probably book the profits in that. They report earnings on February 14th, so you want to stay aware of that too. Finally, INGR, I bought this not too soon after I bought shorted GM yesterday. So I don't like what we're seeing out of it today. I would have liked to have seen some follow through on this bounce off this long-term trend line here. You can see we've bounced off of it once, and then here was a second chance to bounce off of that trend line, which to me I didn't think it was all that mature of a trend line. So, you know, even though it's moved quite a bit, I feel like there's still more room to push higher. But if it closes below this trend line today, I'm not going to hold it any longer. I will cut this stock. So probably at this point, if it closes below 65.89 today, this one's going to be a goner, and I'll move on from there. They also report earnings on the 7th of February, so that will be next Thursday. All right, let's go ahead and look at some of your other stocks here. BCEI, these were recommendations for me to take a look at and give my opinion at. BCEI, I've been watching actually lately. You have a morning, I'm not going to call that a morning star pattern, because the 3 days ago the action there doesn't make it a morning star pattern. But definitely it is breaking out. 32.44 is where it's currently trading at. The breakout level would have been about 32.34. So I do think that it's a legitimate breakout play that you can still get into right now. Oil has been hot lately. You saw some of the action from HES, and some of these other oil companies are doing pretty well. I would put my stop at probably about 31.29. I do like the action a lot in this. I'm not too worried about the early morning gains that it's given back, because if you look over here in the upper left-hand corner on BCEI, it has it doesn't look all that bearish to me. So, and then on a 30-minute chart, it just looks like a light volume pullback. If you look at how the heavy part of the buying and then the light part of the selling there. Let's see, STX. I'm not seeing anything on this one here, quite honestly. Huge sell-off yesterday. There's really no support that it's trading at right now. Maybe yesterday is the only support it's going to find, if any, if that. So I don't see an edge. I don't see an edge for going long or short on this stock, so I would just pass it over. PII. Huge sell-off once again in this one. You do have some support at around 84.75 in this whole dilapidated inverse head and shoulders pattern here that formed from mid-November through the end of December. I get concerned though when stocks sell off this hard about trying to jump into them, because they're already slicing through key support levels, so there's not that confidence level that the current support level that it's trading off of, that it will hold. So, all right, CAT. I could be a buyer of CAT if we could get a pullback to 94.25. It's trading about $4 higher. I don't want to be a chaser at this point. If you're already in it, use that 10-day moving average probably for your stop loss. So right now, if it's trading at 98.68, you would want to put your stop loss at 96.98. So it gives you about $1.60, $1.70 to work with. Price line. This is a quirky stock. Thing always does what you don't expect it to do. We'll pull it on the daily here. All right, so you have this double top that formed back in August through November. It confirmed. It dropped back below key support levels, then busted higher again. That's what I mean. The stock just doesn't. It's not a clean stock for trading. It'll frustrate you more than anything, because you'll get out when you think you should be getting out, only for it to reverse and trade much higher on you, and that'll drive you crazy. All right, so you do have some support back from this June, July, August time frame that it could be pulling back to and finding support at. The pullback looks like it's on light volume on the third consecutive day. Each consecutive day on the 3-day sell-off has been lighter and lighter. If you were to get it, I'd try to get in as close as you can to 693. My stop loss probably would just be below this 10-day moving average. So today it is trading at 687, so maybe like 685. It gives you a good risk reward. I'm not a huge fan for trading price line, but there is somewhat of an edge there in that stock. I don't think it's a very strong edge, but it is a edge nonetheless. Let's look at NVIN here. I got about time for 2 more stocks. Similar to Priceline, you're getting the light volume on the pullback. You got a doji pattern there, so there's definitely some possibilities with this one. Once again, I would use the 10-day moving average, but I wouldn't put it right below it. I'd probably go for maybe like 1390. So I don't know. That probably gives you like a 3 or 4% stop loss. It's pulling back to this, neckline of this double bottom that formed from June through December of last year. Quite the double bottom. So breaks out, pulls back. I think there's a good chance this thing could head to 16, 17. So I'm going to add this to my watch list. I think there's some definite possibilities there, particularly if this market just refuses to cool off. I'm going to have to. I'm sitting at 3 shorts and 1 long right now. The theory would go is that if the market continues to rise higher, one of the stocks I probably will have to get out of would be HDB for a small loss. But in the process too, I'm going to have to hedge my portfolio a little bit more to the long side, because of the simple fact that the market is not pulling back at this point. And while I think it should, it doesn't owe me that luxury of obeying my commands or how I interpret the charts. So last one here, DDD. I see that there's been this bearish wedge because I've drawn it before in the past, and it looks like we confirmed it, only to get back inside of it. Once it started getting really narrow on that bearish wedge, the price action just got really quirky. So, in fact, you could probably say it's not a bearish flag anymore. It's probably trading more well within a defined upward channel. So with that in mind, you want to try and get in probably as close to this like $58 level, and it's trading at 61 right now for it to pop back higher. Because right now it's in the middle of the range there. It's been as high as 63. Range goes up to 74 or so. I think if you were to trade this, I think you would have wanted to have got in yesterday near the lows of the day where it was testing that lower channel. But if you did get into there, I would just keep, riding that thing up and putting my trend or my stop loss below this lower channel until you get a nice push higher that warrants taking your profits in the trade. that's going to do it for now. If you guys have any questions, I'll be in the splash zone. Or you can email me at ryan@shareplanner.com. God bless.